Hey guys, welcome back to another video. This is my financial focus, and in this video I'm going to be talking about the long iron condor options trading strategy. This is a strategy that we can use when we're playing options to profit off of volatility. So I'm just going to be explaining how we can open this trade in Robinhood. Fundamentally, explaining how to open it in Robinhood is exactly the same as opening it in other brokerages. So if anyone watching this video is using like Webull or any other brokerage like that to trade options, then it works pretty much exactly the same way. And I'm also going to be explaining how we can profit off of this strategy and also how we can lose money off of this strategy. So everything to do with the long iron condor. So for this stock, or for this video, I'm going to be using the stock Microsoft as an example. First thing we want to do is click on Trade Microsoft Options. Basically what a long iron condor is it's a call debit spread and a put debit spread combined. So let's say, hypothetically speaking, just as reference here, we can see that in the last month, Microsoft has gone up about $50. So I'm going to be using that as an example for this video for reference. So let's say, hypothetically speaking, that we wanted to mimic the trade that would help us profit off of a $50 movement within a 1 month time period for Microsoft. So let's skip over to December 10th because today it's November 6th. So the first thing that I like to do when I'm opening up a long iron condor is some people like to use the strike price differences, like the difference between the strike price and the share price, to determine what a good price would be, strike price for the option would be for them to open. But that's not how I like to do it. I like to use the delta value, because delta is what actually determines the real distance between the share price and the strike price in terms of profitability. So for me, since we're trying to figure out how to profit off a $50 movement, I'm going to use, say, $80 as my short call strike price. So I'm going to, this is a 5 delta call and 4 delta call. So I'm going to short the 4 delta call and I'm going to buy the 5 delta call. This is going to open up our call debit spread, which is going to be one of the legs for our iron condor, long iron condor. Second that I'm going to do is buy a put, and I have to buy one that's at the 5 delta. So that would be this one right here, and then this is going to be the 4 delta. So I'm going to go long on the 5 delta put, and then I'm going to short the 4 delta put. And once I do that, we can see that, well, it does open up a long iron condor, but unfortunately in Robinhood it just says custom. But this is a long iron condor. Basically how this works is, we can see this chart right here. We profit off of volatility, and the only way that we can lose money is if the share price of the stock remains the same. So if by expiration date December 10th the share price is in between the strike prices for our long call and our long put, so if it's in between $375 per share and $290 per share, then we will lose our total cost, which is 30 cents. But if it's above $380 per share or below $285 per share by expiration date, then we will experience the max profit of $469. So this is a pretty big profit margin, between $31 and $469. Just to give some reference, let's figure out what exactly that profit margin is. So if we did 31 divided by 469, that would come out to, oh wait, I did that wrong, sorry. 469 divided by 30. So that's like a 1,563% profit. So that's decent, I would say. So basically how this works is, the way that we profit is the difference between the strike prices of either our call debit spread or our put debit spread. That's what our max profit potential would be, and then whatever that value is, we just subtract how much we spent to open up the trade. So for instance, in this example, the difference between our short call and long call strike prices is 500. 500 minus 31 comes out to 469. So it's basically the difference between the strike prices for either the call debit spread or put debit spread minus a total cost. That's going to show us our total profit. The opposite trade to a long iron condor is a short iron condor. And I made a video in the past about how to open up a short iron condor on Robinhood. So If anyone didn't see that video, definitely go check that one out. But basically how it works is a short iron condor is a trade that allows someone to profit off of a neutral movement in the share price. So if on expiration date, the share price of Microsoft is in between the strike prices of the long call and the long put, then that person would experience their max profit. And that can easily be seen as just being a reverse of the max profit and max loss of the long iron condor. So in this case, if someone were to short the 290 put, go long on the 285 put, and then short the 375 call and go long on the 380 call, they would essentially be risking $469 for the potential max profit of $31. And so whenever somebody opens up a long iron condor, they're essentially betting against a second party who is opening up a short iron condor. And so if the person who opens up the long iron condor wins, that means that the person who opened up the short iron condor essentially lost the $469. And if the person who opened up the short iron condor wins, then the person who opened up the long iron condor basically loses their total cost of $31. The last thing that I want to talk about is exactly how we can calculate, like, on a percent basis, what the profit and loss potential of our long iron condor would be. And how that works is for every penny that the share price of Microsoft in this example drops below 290, we gain $1 of our max profit. So in other words, we have to go through, first we have to experience a $30 or $31 in this case decrease below the strike price for our long option. So remember that whenever we're dealing with options, we have to multiply the values by 100. So in this case, if it's $31 of max loss, what that really means is that in order for us to experience that $31 profit, we have to lose 31 cents beneath $290 for the strike price of our long put. So let's say the share price for Microsoft dropped to 289. What is that? 289.69. So if it dropped to 289.69, we would basically break even. So we can see right here, it says 289.69 would be our break even point. And the reason why that is because if the share price drops 31 cents below the strike price of 290, then we make $31. And since we spent $31 in order to open this up, that would be our break even price. And so everything after that 31 cent drop would be an extra $1 of profit that we experienced from our max profit of $469. So let's say it dropped to I don't know, like if it drops from 290 to like 286, for example, then we would make $369 because we're $1 off from our max profit, and $1 times 100 is $100. So if this share price drops to $286 per share, then we'll be sitting at a $369 profit on expiration date. Now, if in order to experience our max profit of $469, it would have to expire at 285 or below 285, because that would mean that the full $500 difference between our strike prices was realized for the put debit spread here, and then we would just subtract our total cost, which is 31 cents, and that would give us our max profit. The same exact thing can be said for the call debit spread. Hypothetically speaking, upon expiration date, if the share price of Microsoft rises 1 penny above 275, above 375, then let's say if it's at $375.01, that is 1 penny of not profit, but 1 penny that we've collected. And remember, since we spent 31 cents to open it up, we have to experience at least, in order to break even, we have to experience at least a 31-cent increase above 375 in order to break even. So we can see right here, the other break even point is $375.31, because once it rises to that point, we've officially collected $31, which is exactly how much we spent in order to open it up. And then everything after that would become $1 of profit of our total $469 of profit. And keep in mind, the only way that we can actually experience the maximum profit is on expiration date, because the option premiums for options contracts, they will always at least have like 1 penny of value before expiration date because of the time value, which is basically indicating the chance that the option can expire in the money if it is out of the money. And so before expiration date, if the share price of Microsoft is above the strike price of our short call or our short put, theoretically, some people might think like, why I should have the max profit at this point, right? But the reason why that isn't the case is because of the extrinsic value that's still left in the premiums of the options contracts. In order for us to experience the max profit, there has to be 0 extrinsic value in our options contracts, and there can only be intrinsic value left. Because if there's only intrinsic value left, and let's say the share price is above $380 per share, that would mean that intrinsically we have the option to buy Microsoft at $375 per share, since we have the right but not the obligation to buy the stock at the strike price on expiration date. But since we went short on the short call, we would technically have to we would have to sell 100 shares of Microsoft at $380. And so since on expiration date neither one has any premium left and the only value they have is if they're exercised or not, then the difference between the strike prices is finally realized because there's no extrinsic value left and only intrinsic value. So the difference between the spread at that point would be a full $500. So that's the only point that we can experience our max profit. Hopefully that made sense. I tried to make it like a beginner level understanding of options. It's a little bit complicated, but if it didn't make that much sense, just rewatch the video again. Definitely leave a like on this video if it provided any value to anyone who was watching it. Subscribe to the channel if you guys haven't already, and I'll see everyone in the next one.